Let's talk about retirement. You probably already have a plan to get there. Maybe you have a goal to retire early someday, and that's awesome. But once you retire, do you plan to spend money from your taxable account first or your retirement account? And if you expect to receive retirement benefits from the government, what age do you want to take it at? We spend a lot of time planning to accumulate a large nest egg. Well, the decumulation phase is important to think about too. In fact, it might be even more important to talk about it because as you get older, the less you can rely on active work income to support your living expenses in case your retirement plan falls short. So, in today's video, let's explore how to create a sustainable withdrawal strategy to produce consistent income throughout your retirement. Generally speaking, it's a good idea to delay taking money out of your tax sheltered vehicles to give them more time to compound tax free. But that's not always the case, so let's take a look at an example. A lot of people watching this probably want to be early retirees. So let's say you retire at 50 years old, and in your individual retirement account or your registered savings plan, you have $400,000, which is about the average for people looking to retire. And let's say you have $300,000 in a tax free account. This could be a Roth IRA or a TFSA or something else that lets your investments grow tax free. And any money you take out is not taxable. Just be careful with the Roth because there are age limitations when you withdraw. I think $300,000 is reasonable because with a tax free savings account, for example, if you contribute the maximum right now, and let's say you're 30 years old, and you keep making the maximum contribution every year for 20 years, then if you can make a 7% annualized return, you'll have $300,000. And finally, let's say you have a taxable investment account, which is also called a non registered account. If you contribute $2,000 a year indexed to inflation, starting from now, then in 20 years you'll have about $100,000. And like two-thirds of the people in the country, you are a homeowner, and you bought it when you were 40 years old, let's say. So in total, you have $800,000. If you spend $50,000 a year in retirement, then this is one example of what your withdrawal strategy could look like. We can also assume a 2% annual rate of inflation. That's the Bank of Canada's target, and we can get an annualized investment return of 7%, which I think is reasonable given stock market returns in the past. So, generally speaking, you want to front load a lot of your retirement income in the beginning years. This is because RRSP withdrawals are considered taxable income at your marginal rate. So you want to reduce your withdrawals after government benefits kick in, otherwise you'll have way too much taxable income. So that's why in the first year, you could withdraw $30,000 from your RSP, $17,000 from your tax-free savings account, and then $6,000 from your non-registered account. Now, depending on if this $6,000 is coming from capital gains, eligible dividends, or return of capital, the tax rate will be different. Eligible dividends are very tax efficient, which is why a lot of people like to hold dividend growth stocks inside a taxable account. So add all of these sources of income together and you'll get $53,000. Now, about $3,000 of this will go to the government as tax. Now, that's an average income tax rate of 6%, which is pretty low. And you're taking advantage of the lower tax bracket by withdrawing from your RSP. And every year you just take out 2% more than you did the previous year, and that'll cover your cost of living expense until age 65, and this is when you can receive government benefits. I'm going with the average CPP benefit amount, which I think is reasonable, and a similar figure for old age security. And because these are both taxable incomes, you'll probably want to reduce your RSP withdrawals. Now, for a lot of people, delaying government benefits is more beneficial. And I'll explain this a little later in the video so it makes sense. But for now, let's keep it simple and say you want to take the benefits starting at the standard retirement age of 65. And then something really cool happens at age 70. The home that you bought when you were 40 is now clear title because it's been 30 years and you've paid off the mortgage. So your biggest household expense is now gone forever. I think this is a crucial point in your decision making if you're ever considering to buy or rent. Even if the calculation shows that buying is more expensive than renting, you have to consider all the money saved from not having a mortgage anymore after the first 25 or 30 years. So due to the cheaper cost of living now at age 70, you can spend a little bit less on your TFSA and RSP just to give them more time to compound tax-free. And it's around this time that you can also convert your RSP into a RRIF, which is a registered retirement income fund. And after a certain age, there is a minimum percentage amount that you have to take out of your RRIF every year. And that percentage goes up as you grow older. So I'm going to bring in this other chart here, which basically shows the actual drawdown of the different accounts. This is a stacked graph, so everything put together in the beginning is 800,000, and you can see until age 65, the balances of the TFSA and the taxable account doesn't really change much. It's the RSP that's being slowly depleted. And of course, that was intentional because tax reasons. And then from age 80 to sort of age 90, you have this buildup of non registered investments. I think this is a good idea because taxable accounts are very flexible. You can use margin and borrow against the securities you have in there. You can control what kind of taxes you pay depending on what you want to invest in. You can write off losers against your winners. You can use some conservative option strategies like covered calls to earn some consistent income. And it's overall just more versatile than a registered account. So, if you run into any large financial emergencies, having a margin account is a really useful tool. And throughout this entire time, from age 50 to 100, your income tax rate on average is going to fluctuate around that 6% range every year. The key is to evenly distribute the taxable income over time. Now, you might be thinking taking $53,000 out in the first year of an $800,000 portfolio seems kind of risky. That's a withdrawal rate of 6.6%. Generally, people are comfortable with the 4% rule or saving up 25 times your annual spending. But in this case, $800,000 in savings is just 15 times. So, would this strategy actually work out? In reality, probably not, because this graph assumes perfect conditions, like inflation is always at 2%, and every year you make 7% return on your investments. But in the real world, everything is fluctuating and you have sequence of returns risk and you have market crashes and melt ups. So to combat those sort of risks, you can do a few things. The first is to build a more resilient portfolio. There are investments that you can put together that will give you a higher safe withdrawal rate than the traditional 4%. The golden butterfly is one example which I've discussed before. You can also use a variable withdrawal rate. So instead of every year withdrawing $53,000 adjusted for inflation, you would instead have a range, maybe 50,000 to 55,000, and the actual amount that you can take out within that range will be dependent on how the market is performing that year. So in bear markets, you give your portfolio more time to recover. And the third way is to just lower your withdrawal rate or make more money. Earning some extra money in retirement always helps to prolong the life of your portfolio. As you can see, these strategies can get quite complicated. My friend Mark over at Cashflows and Portfolios knows a lot more about this topic than I do. He has written extensively on retirement planning, and he even helps people create custom drawdown reports using professional financial software. I'll leave a link to his site in the description below so you can check out his content. The truth is, everyone's retirement plan will look unique, but instead of only showing a hypothetical situation, I will now share my own decumulation strategy. Usually, I think like half the viewers leave by the time they get to this point in my longer videos like this one. So, thank you for sticking with me so far. I hope you're learning something new, and let me share with you some news. I am planning to retire later this year when I turn 35 years old, so I'm pretty excited about that. Now, let's take a look at my personal drawdown chart as of today, because this can always change. And I don't have to use hypotheticals because these numbers are real. So in my RSP, I have $260,000. Our TFSA is $190,000, all combined. And I have a taxable account at $400,000. This is my margin account with Interactive Brokers. So those are all our liquid assets at $850K. We also have rental properties worth over $1 million, and they bring in some decent income. Now, I still have to make some assumptions, of course, because we are projecting into the future. My grandpa is celebrating his 100th birthday this year, so he'll be a centenarian. I think every generation adds like 5 years to life expectancy or something. So if I'm careful, I could live past 110 years old. So I've decided to extend this chart out to 120 years old just to be safe. And I'll keep inflation and the annual investment return at 2 and 7% respectively, just to keep things consistent. And this is what my 85 years of retirement look like. Wow, that's going to be a long time of drinking cocktails on the beach. I was actually going to tell some jokes about retired people, but none of them work. So let's dive into my retirement income graph here, starting from the first year, which will actually probably be next year, 2023. Our household spending is roughly $70,000 between my wife and I, and here's how we plan to cover that cost for the first year. $20,000 will be withdrawn from retirement accounts, $10,000 of tax-free income from the TFSA, $22,000 from the margin account. This is mostly from eligible dividends and some capital gains. And finally, $33,000 of net cash flow from our rents. So this is our total rental income minus mortgage payments, property taxes, maintenance, and any other expenses related to real estate investing. This comes to a total of $85,000 for the year. We can use a little bit of income splitting, so our total tax burden will be less than 10% of that. That leaves us with $77,000 that we can spend, which includes a nice 10% cushion to our budget. So we'll use the extra money if we need to, but if not, we'll just roll it into our investments to make us more money in the future. So every year we will take out 2% more to cover inflation. And when I'm 55, you can see there's this noticeable jump in our rental income. This is because one of the properties will be mortgage free. This will boost the cash flow because there is no longer a monthly mortgage payment. This happens again at age 60, where the second property will also be mortgage free, while at the same time I plan to start taking CPP benefits. It won't be a lot because obviously I haven't paid that much into it, but I think it's better to take it earlier than later because at least I can start spending the money. Using this online CPP benefits calculator, we can see here I'm this blue line here taking CPP at age 60, and the line represents over time how much total income I am making from CPP. The green line is what happens if I take it at 65, which you can see it's steeper, meaning I will get paid more right away. And you can see the break even point is at age 73. Now, if I wait until even later, till age 70, you can see the green line becomes steeper, and then the break even age at this point between 60 and 70 is 78, meaning if I died before 78, I would be better off taking CPP benefits early. But of course, after that age, the green line and blue line diverge, and I'm much better off waiting to get CPP. But this assumes I don't do anything with the CPP benefits if I get it early. So if I adjust the rate of return and move this higher to maybe like 7%, you can see my break even age gets longer. And that's because I'm adding additional value to my money because I'm getting those investment returns. And at 8% return, you can see the break even age is now at 87, so it's pushed further into the future. And at 10%, they don't even intersect. But back to a reasonable return of 7%, which has a break even age of 84. My thinking is there's no guarantee I'll live to 84, so if I die before then, it's better to take CPP early. And the other thing is you can't measure a return on investment for the money you spend on something you enjoy. Plus, because of the investment strategies that I use, I don't think it's difficult to get a near 10% rate of return over time. And lastly, I don't want to risk like delaying until 70 and then all of a sudden something happens at 70 and then I can no longer enjoy it. I mean, they have the CPP survivor benefit for the surviving spouse, but it's not much. So for all those reasons, I've decided to take CPP early. Now, if you're wondering at what age should you start taking CPP benefits, a general guideline is if you think you can make a 7.3% annual rate of return on your investments, then you should take CPP early. But if not, then you should delay CPP, and that's purely just based on numbers. So if you wait until 65 instead of getting it at 60, then your first payment will be 36% more. So back to the chart, after a few years, my wife will start taking her CPP as well. And then at age 65, there's a couple of tailwinds. One is our principal residence will be paid off. This is the home we live in right now. And the other is I will start to collect old age security benefits, and my wife will start soon after. And I expect us to both get full benefits here. And again, I would rather take this at the earliest time at 65 instead of delaying it until 70. Now, if you don't need the money and you're thinking about delaying one of them, it's better to delay CPP. So if you want to take one of them and delay the other, take OAS first because from 65 to 70, every year that you wait, your benefit will go up by 7.2%. But for CPP, your benefit will go up by 8.4% per year. So it's more worth it to wait for the CPP. And we just plan to follow the course until the end. You can see towards the later half of my retirement, I expect to spend more money from my TFSA and my non-registered. I'll probably deplete my RSP in my late 60s or early 70s. I think it's a useful vehicle when you're trying to save money in your high income earning years. And then it's useful to take that money out when you're in a lower tax bracket, but before taking taxable government benefits. But then after age 65 or 70, it just becomes a very clunky, tax inefficient vehicle to work with. By the way, this is our liquid portfolio throughout the retirement. Even though we've withdrawn a lot of money, especially near the end, there's still $5 million left over in our accounts. Now, you might say, why not spend more money earlier? And then that way you can enjoy it more because you clearly don't need to save all that much in the end. But the thing is, exponential growth over a long period of time can be very finicky and very sensitive to any changes in the variables. For example, if we assume instead of 7% investment returns, Maybe we try something more conservative like 6%. So instead of having $5 million at the end of my retirement, look what happens. At 6% annual return, the chart basically flips. And I'm down like to negative 15 million, negative like $18 million. What's actually going to happen in reality though is it's not so much I'm going to owe that much in debt, but it looks like about 65, somewhere around mid 60s, I'm just simply going to run out of money. So I will be spending more money than I make from my portfolio and from other retirement income. And that's not going to be very fun. So most people, they retire at 65, they're going to enjoy what they have. And at 65, I'm going to be broke, and that's not going to be very satisfying. So let's change this back to 7. That's better. But we can, think the opposite and be a little bit more optimistic because historically the stock market has returned, 8 to 10% a year over the long run. So let's change this to 8 and see what happens. Boom. Skyrocketing up to it's like $85 million. This is actually a little bit misleading. The retirement account, the RRIF, basically, will not actually do that because there's a minimum withdraw amount every year. It's like after 95, it's like 20% or something. So if we take that out, that's still like 70 or 60 or $70 million from 7%, like 5 million. So that's a huge jump with just a single point percentage change. Oh, by the way, I want to give a shout out to D Investor for suggesting I talk about drawdown strategies. I wouldn't have made this video otherwise. If you can think of any topics you'd like me to cover in the future, just put a comment below. So to summarize everything in this video, I'll just leave you with 5 points. 1. A lot of variables and factors go into making these decisions, including are you making income from dividends or capital gains, the inflation rate, your total returns, and a small difference in any of these factors can have a huge difference in the final outcome. 2, there's no such thing as the perfect drawdown strategy. That's because everyone's situation is different and those situations are constantly changing. So the only way to properly plan for a successful portfolio drawdown is to have a basic plan of what you need first and then revisit it at least once every few years. And then maybe every year as you get closer to your retirement date. 3, be flexible with your plan and don't get too attached to the numbers. Understand that you will have to pivot and make big changes. For example, maybe the government will change the retirement age, and you'll have to wait longer to get your retirement benefits. In my example, realistically, I don't actually expect our rental income to continue like all the way till the end for like 85 years. I mean, one of our properties is already 40 years old. It probably won't last that much longer, which means at some point in the future, I'll probably have to sell it. And then I can put the proceeds into a diversified dividend portfolio to generate like 4% in income a year. And this would replace the rental income that I would lose by selling the property. Now, it's really hard to say when that's going to happen. So that's why I've kind of just left it out. But when it comes time to actually like get rid of the condo and decide what to do with the proceeds, I will make the changes to my plan. 4, adopt a long-term investment horizon even if you're already retired. There's an old adage that you should invest in lower risk, lower return assets as you get older. But if you plan to retire early, you could have like 50 years of retirement living. So that's a very long time. And choosing to invest in a more conservative portfolio may appear to be safer, but it could actually cause retirees to run out of money in their later years. So that's a risk in itself to be aware of. And finally, number 5, becoming financially independent isn't just a goal you set for yourself, it's actually a lifestyle that you have to embody. So traditional FIRE may not be for everyone, but there are so many different flavors of the movement, like Coast FIRE and Spouse FIRE. So if you want to learn more about the different FIRE variations, you can check out this video here. Of course, there are a lot of nuances when it comes to drawing down your portfolio, but hopefully this provided a general overview of what a decumulation plan looks like for someone near early retirement. Anyway, thanks a lot for watching, happy investing, and I'll talk to you in the next one.